For decades, we've lived in an era defined by a powerful economic force, cheap money. But as we're starting to discover, this solution to yesterday's problems might just be the source of tomorrow's crises. This is the story of how an attempt to save the economy created a cascade of unintended consequences, ones we are only now beginning to fully comprehend. It all begins with a simple yet potent idea. To stimulate a sluggish economy, central banks turned on the spigots, unleashing a torrent of currency. This wasn't just about printing physical cash, it was a digital deluge. They slashed interest rates to historic lows and initiated massive bond buying programs, a policy known as quantitative easing. The goal was to make borrowing so inexpensive that businesses would invest and consumers would spend, jump-starting economic growth. In theory, it was a flawless plan to avert a downturn. But in reality, this flood of cheap money didn't flow where it was supposed to. Instead of fueling Main Street, the capital gushed into Wall Street, inflating a colossal asset bubble. The stock market, detached from the real economy, soared to dizzying new heights. We saw tickers flash green day after day, creating immense paper wealth for those already invested. At the same time, real estate prices skyrocketed, turning the dream of home ownership into a nightmare for a new generation. A confident investor, surrounded by rising charts, toasted his success, while a young couple stood defeated before a house whose price tag had spiraled far beyond their reach. The very policy meant to create opportunity was now locking people out of it. This divergence created a chasm in society, a widening gap between the haves and the have-nots. On one side, the wealthy, whose assets were supercharged by the endless supply of credit, saw their fortunes multiply. They enjoyed lives of unprecedented luxury, their wealth growing faster than ever before. On the other side were the savers, the fiscally responsible who had played by the old rules. An elderly man, staring at his pension statement, saw his life savings stagnate, eaten away by inflation. The near-zero interest rates designed to encourage borrowing actively punished those who had diligently saved for their future. The system incentivized a dangerous dependency on borrowing. For individuals, businesses, and even entire governments, the temptation of low-cost debt was irresistible. Corporations took on massive loans not to innovate or expand, but to buy back their own stock, artificially inflating their share prices. Governments, too, embraced deficit spending on an unprecedented scale, financing projects with borrowed money and accumulating mountains of public debt. This era of easy credit wrapped heavy chains of liability around the global economy, setting the stage for a painful future reckoning. Now, the party is ending, and the inevitable hangover is beginning to set in, as central banks are forced to raise rates to combat the inflation they helped unleash. The foundation of this artificial prosperity is cracking. The flood of cheap money is receding, revealing a barren economic landscape beneath. The asset bubbles are showing signs of popping, and the burden of debt is becoming unbearable. The question that hangs over us now is not just how we will navigate this crisis, but who will ultimately be forced to pay the price for this grand, expensive experiment.